All right, let's pull back the curtain on one of the most complex but absolutely critical parts of our financial world: insurance risk management. It's this massive financial balancing act, and today we're going to break down exactly how it all works.
I mean, really think about that for a second. An insurance company takes your money today and makes a solid promise to cover you for something bad that might happen way down the road. How on earth can they make that promise with any real confidence?
Well, the secret is it's not a guess. Not at all. It's not about crossing your fingers and hoping for the best. It's a really sophisticated system of risk management, intense mathematical modeling, and super strict regulation. All designed for one thing: to make sure that promise can be kept no matter what happens.
Okay, so let's dive right into the heart of it. We're going to start with the absolute core of what insurance is all about.
So at its very heart, an insurance contract is just a formal transfer of risk. You're basically paying a fee, the premium, to hand over the financial worry of some future catastrophe to the insurance company. And this creates that huge balancing act we're talking about. They have to perfectly manage all the money coming in today to be absolutely sure there's enough to pay for all the potential claims of tomorrow.
So, how do you actually make sure that promise is kept? Well, you need a seriously strong set of rules. And in Europe, the gold standard for this is a framework called Solvency II. You can think of it as the modern rulebook that tells insurers exactly how to manage their money to protect people like you and me.
And the one goal of Solvency II, the whole point, is to ensure this: solvency. It is the single most important measure of an insurer's financial health. It's the ultimate proof that they have the cash on hand to pay out every single legitimate claim, even when things get really, really messy.
Now, this balance sheet, think of this as our map for the next few minutes. On the left, you've got assets, what the insurer owns. Things like investments, and you'll see reinsurance assets there. Reinsurance is basically insurance for insurance companies. It's a key way they manage enormous risks, like a hurricane. But we're going to focus on the right side, what the insurer owes. Let's break this down.
So the biggest piece of what an insurer owes is something called technical provisions. This is the main pot of money that they've calculated they'll need for all their future claims. But it's not just one big number. Regulators make them split it into two very specific parts, just to make sure they're being both accurate and cautious.
The first part is the best estimate liability, or BEL. So how do they get this number? Well, imagine they run thousands, even millions of computer simulations of the future. Some scenarios have very few claims, others have a ton. The BEL is basically the average result of all those simulations. It's their most logical, data-driven, and totally unbiased guess of what they'll have to pay out.
But, the best guess just isn't good enough for regulators. On top of the BEL, they add a risk margin. So a simple way to think about this is to answer the question, what if this insurer just vanished tomorrow? The risk margin is an extra buffer to make sure there's enough cash to pay another company to step in and take over all the policies, keeping that promise to every single customer.
And finally, on top of all of that, we have the ultimate safety net, the Solvency Capital Requirement, or SCR. This is the insurer's own skin in the game, their own money. It's completely separate from the funds for expected claims. It's just like the airbag in your car. It just sits there. You hope you never, ever need it. But it has been designed and tested to absorb a massive, unexpected shock. So, what does a massive shock look like? Well, it comes down to this number. The SCR has to be big enough to give the insurer a 99.5% confidence level of surviving the next year. To put that another way, it has to be enough capital to get through a devastating 1 in 200-year disaster. That's an incredibly high bar for security. Okay, so a 1 in 200-year safety buffer. That sounds pretty impressive. But how do you actually calculate a number that big? Let's take a look inside the engine room.
So insurers basically have two paths they can take. Most use the standard formula. It's a one-size-fits-all model provided by regulators that's designed to be pretty robust. But for really large, complex companies, a generic model might not be the best fit. So with very strict approval, they can build their own internal model. It costs a fortune and takes years to develop. But a tailor-made model that truly reflects their unique risks can be way more accurate and efficient. For our purposes, we'll focus on the standard formula that most companies use. The standard formula breaks down all the bad things that could happen into different risk buckets. So you've got market risk, what happens if the stock market tanks? There's default risk, what if a company they loaned money to goes belly up? And then there's the big one, underwriting risk. That's the core insurance risk that you simply get way more claims than you ever predicted.
So the system combines all these different risks in a really logical three-step process. First, it figures out the capital needed for every single tiny risk. Then, it groups those into their main buckets, like market risk. But the real genius, the really clever part, is in step 3, in how it combines all those big buckets together. And that's where this comes in. This table brilliantly illustrates the power of diversification, using something called a correlation matrix. The model is smart enough to know that a giant hurricane, a CAT event, and a wave of customers suddenly canceling their policies, a lapse event, are very unlikely to happen at the exact same time. See that 0? Because those risks aren't connected, you don't just blindly add the capital for both together. The model accounts for this, which leads to a much smarter, more efficient capital buffer.
Okay, so we've seen the what and the how. But let's zoom out. Let's connect all this complicated math back to the real world and talk about why this whole balancing act actually matters so much.
Yeah, it really does all come back to this fundamental question, doesn't it? How can you possibly build such a detailed financial model of a future that literally hasn't happened yet? Well, the answer is a field called actuarial science. Actuaries are the architects of this entire system, and they use incredibly powerful statistical tools. Some of these have been around for more than 100 years. A classic example is the Poisson distribution, which is really just a fancy name for a mathematical model that is ridiculously good at predicting how often random events like car accidents are likely to happen over a period of time.
And look, this isn't being done with a pencil and paper anymore. Today's actuaries are basically data scientists. They bring these sophisticated models to life using powerful programming languages like R and Python. These are the tools that let them dig through mountains of data and turn it all into real actionable insights about risk. So let's wrap this all up. What are the big things to remember? First, solvency is everything. It is the absolute bedrock of trust in insurance. Second, Solvency II isn't just a bunch of rules. It's a highly advanced framework for wrestling with risk. Third, diversification is real. It's a mathematical principle that makes the whole system work better. And finally, and this is the most important part, all of this complexity exists to protect you, the policyholder, and the stability of the entire financial system. But of course, the world of risk never stands still. How does a model that's built on 100 years of data predict the cost of a brand new type of cyber attack? Or account for the fact that 1 in 200-year storms seem to be happening a lot more often because of climate change? So the final question isn't just if these frameworks have to adapt, but how quickly they must evolve to keep that fundamental promise of insurance safe in an even more uncertain future.